Boom. I think we're live. Okay, so this is going to be about any MMDAs, money market deposit accounts. If we have time later, we're going to do we're going to read the book by Ramit Sethi. I Will Teach You to Be Rich, I think is the book where Ramit Sethi. Okay. That's if we get through with that pretty fast. So money market account.
Go to Wix.com and set up your. The legal cannabis industry has surpassed $36 billion. To grow,
Get some music going.
to sale. We provide the education to help you lead cannabis forward.
Boom, okay. So money market account, oh great, there's a video, so I don't even have to play the music. Let's see.
A money market account is an interest-bearing account that pays a higher interest rate than a savings account and gives the account holder limited check writing ability. It combines the benefits of savings and checking accounts, but usually requires account holders to maintain a higher balance in exchange for the higher interest rate. Summer has checking and savings accounts at her bank, but the checking account pays 0.5% interest and the savings account pays 1% interest. She doesn't write many checks. Her average daily balance is $5,000, and she wants to earn a higher interest rate without taking on more risk. She learns that her bank offers a money market account which lets her write up to 6 checks per month and requires a minimum balance of $2,500. It's FDIC insured like her checking and savings accounts, but pays 1.5% interest. Summer decides to close her savings account and move most of her money into the money market account. She keeps some money in her checking account to pay her bills. The interest Summer earns on her money market account is taxable, but so is the interest she earned from her savings account. The bank invests her deposits in low-risk assets like certificates of deposit, U.S. Treasuries, and commercial paper. Money market accounts are widely available through banks and other accounts. Summer decides to close her savings account and move most of her money into the money market account. She keeps some money in her checking account to pay her bills. The interest Summer earns on her money market account is taxable, but so is the interest she earned from her savings account. The bank invests her deposits in low-risk assets like certificates of deposit, U.S. Treasuries, and commercial paper. Money market accounts are widely available through banks and other financial institutions. When Summer makes her annual contribution to her Roth IRA, she learns her brokerage has a better money market account paying 1.9% interest. So Summer moves her money again. Her brokerage operates online and has lower overhead than her bank, so it can afford to pay account holders a better interest rate. Even though Summer's new money market account is with a brokerage, it is still FDIC insured, and her money is still invested in low-risk assets.
Okay, so just my initial impression is like it's some sort of alternative to a high yield savings account that's based on investing in low risk assets, which kind of seems similar to index funds. So I'll read more and figure out what is a money market account. Let's put back the music. The term money market account refers to an interest bearing account at a bank or credit union, sometimes referred to as a money market deposit accounts. Money market accounts have some features that are not found in other types of accounts. Most money market accounts pay a higher interest rate than regular passbook savings accounts and often include check writing and debit card privileges. Okay, let me read that again. Most money market. They may also come with strict restrictions that make them less flexible than a regular checking account. They are important for calculating tangible net worth, okay? Money market accounts are offered by banks and credit unions and provide the benefits and features of both savings and checking accounts. They generally pay higher interest rates than regular savings accounts and may come with debit cards and limited check writing privileges. Money market accounts are suited for short-term goals rather than long-term financial planning. Many banks also offer high yield or high interest checking accounts, which may pay better rates than most money market accounts but impose more restrictions. Alternatives to money market accounts include high yield savings accounts and certificates of deposit. Oh my God. Okay. How money market accounts work. Money market accounts are financial products that are offered to customers at traditional and online banks and credit unions. They give account holders some of the key benefits of a savings account while providing them with the features of a checking account, including interest. Like savings accounts, MMAs allow account owners to earn interest on their balances. The interest rate offered is normally higher than a traditional savings account. The interest rate, though, tends to be variable, which means it can fluctuate as market conditions rise and fall. Debit cards. Some banks include a debit card with the account, which allows owners to use automated ATMs to make deposits, withdrawals, and transfers. Okay. Check writing. Along with debit cards, clients may also be able to write checks against their account balances. Banks often require a minimum initial deposit in order to open an MMA, and balances must be retained over a certain threshold while they are active. Banks may impose a service charge if the balance falls below that minimum amount. Most money market accounts are suited for individuals who want to earn more interest than they would with a savings account with short-term goals in mind. As such, an MMA may be a good idea if you're saving for a specific purchase, such as a vacation, a down payment for a car, or for a rainy day or emergency fund. They are not intended for long-term purposes like retirement. Okay. Until the early 1980s, the federal government placed a cap or limit on the amount of interest that banks and credit unions could offer customers on their savings accounts. Many institutions gave out small appliances such as toasters and waffle irons and other incentives to attract deposits because they couldn't compete with money market mutual funds when it came to interest rates. Introduced in the 1970s, money market mutual funds are sold by brokerages and mutual fund companies. Under pressure from the banking industry, Congress passed the Garn-St. Germain Depository Institutions Act in 1982. This new law allowed banks and credit unions to offer money market accounts that paid a money market rate, which was higher than the previous capped rate. Okay. Advantages and disadvantages of money market accounts. There are advantages and disadvantages to having a money market account, especially when you compare them to other types of accounts. Their advantages include higher interest rates, check writing, and debit card privileges. Banks and credit unions generally require customers to deposit a certain amount of money to open an account and to keep their account balance above a certain level. Many impose monthly fees if the balance falls below the minimum. These accounts also provide federal insurance protection. Accounts held at banks are insured by the Federal Deposit Insurance Corporation, while those held at credit unions are insured by the National Credit Union Administration. The FDIC and NCUA Covers certain types of account, including MMAs, up to $250,000 per depositor per bank. Multiple insurable accounts at the same bank. Checking, savings, certificate, deposit account towards the 250,000 limit. Joint accounts are insured for 500,000. Okay. That's a lot of money. Potential disadvantages include limited transactions, fees, and minimum balance requirements. Higher interest rates, check writings. Debit cards, insurance protection, limited transaction fees, and minimum balance required. For depositors who want to insure more than $250,000, the easiest way to accomplish this is open accounts at more than one bank or credit union. I want to see, does Fidelity count as a bank? Interesting. Is my Roth IRA FDIC insured? Is Fidelity Roth IRA FDIC insured? Okay. One of the attractions of money market accounts is that they offer higher interest rates than savings accounts. For example, the average interest rate for an MMA in May 2022 was 0.08%, while the average savings account paid about 0.07%. When overall interest rates are higher, as they were during the 1980s, 90s, and much of the 2000s, the gap between the two types of accounts will be wider. Most money market accounts can offer higher interest rates because they are permitted to invest in certificates of deposit, CDs, government securities, and commercial paper, which savings accounts cannot do. The interest rates on money market accounts are variable, so they rise or fall with inflation. How the interest is compounded yearly, monthly, or daily, for example, can have a substantial impact on the depositor's return, especially if they maintain a high balance in their account. Unlike savings account, many money market accounts offer some check writing privileges and also provide a debit card with the account, much like a regular checking account. Warning: the lines between are increasing a burden. You may want to compare both money market accounts and savings account rates to ensure you're picking the best product for you. Money market and checking accounts share some basic characteristics the same way they do with savings accounts. Account holders can make unlimited deposits, Some of them even offer debit cards, which allow account owners to make point-of-sale transactions. They can also write checks against them MMA too. In April 2020, the Federal Reserve listed restrictions set for accounts like MMAs under Regulation D. Prior to this, depositors were limited to a total of 6 transfers and electronic payments per month. The type of transfers affected were pre-authorized transfers, including overdraft protection, telephone transfers, electronic transfers, checks or debit card payments to third parties, ACH transactions, and wire transfers. Depositors who exceeded the limits were fined. Although the rules were amended under federal regulations, some banks may still impose such limitation and restrictions on how their MMAs may be used. As such, it's important to check with your financial institution about the rules. Unlike the various bank and credit union accounts described above, money market mutual funds offered by brokerage firms and mutual fund companies are not FDIC/NCUA insured. Banks may also offer mutual funds, but they aren't insured either. However, because they invest in safe short-term vehicles such as CDs, government securities, and commercial paper, they are considered to be very low risk. Both money market accounts and money market mutual funds offer quick access to depositors' cash. The companies that offer them, however, can place limits on how often depositors can make withdrawals or redeem shares. Others may require that any checks they write be for over a certain amount. The returns on money market mutual funds tend to be higher than those on money market accounts. The table below compares some of the common features found in money market accounts and other types of deposit accounts. Because interest rates and other provisions can vary from one financial institution to another, it's worth shopping around. Okay. Alternatives to money market accounts. Banks and credit unions offer many types of accounts, some with features that can make them competitive with or superior to money market accounts. Unlike money market accounts, regular savings accounts typically have no initial deposit or minimum balance requirements. They also pay interest, although usually not as much as money market accounts. Like money market accounts, passbook savings are FDIC/NCUA insured. Check with your bank to see if there are any restrictions. Many banks and credit unions also offer high-yield savings accounts, and depending on the institution, the interest rate may be better than on their money market accounts. High-yield savings accounts are also FDIC or NCUA insured. A potential downside compared with money markets is that they may have more rules, such as requiring direct deposits. Right. Okay. Checking accounts have one big advantage over their money market cousins: unlimited transactions, including checks, ATM withdrawals, wire transfers, and so forth. They are also FDIC or NCUA insured. Their main disadvantage is that they pay a very low, often zero interest rate. High yield / high risk, high interest checking accounts. High yield savings accounts. Like high yield savings accounts, these accounts offer interest rates that rival and sometimes exceed those of money market accounts. They also share the high yield savings accounts' principal weakness, which is that they may have more complicated requirements, such as the minimum number of debit transactions each month. They also impose a cap. For example, 5,000, above which the highest interest rate does not apply. In other respects, high yield checking is like regular checking with unlimited checks, a debit card, ATM access, or FDIC or NCUA insurance. Rewards checking account. This type of checking account may offer a sign-up bonus and other rewards such as high yields, ATM fee reimbursements, airline miles, or cashback. The main downside is similar to high yield checking, notably high fees unless the depositor satisfies all the rules, which vary by the institution. Otherwise, the rewards checking functions like a regular checking account, including FDIC or NCUA insurance. A CD is like a savings account with a fixed duration such as 3, 6, 9, 12 months, or multiple years up to 10. In exchange for locking in their money for that period of time, depositors generally get a higher rate of interest than they would with a regular savings account. However, if they withdraw their money or part of it early, they'll pay a penalty, usually in the form of lost interest. Some CDs, known as liquid CDs, don't penalize depositors for early withdrawals but pay a lower rate of interest. CDs are FDIC or NCUA insured, but typically offer no provision to write checks, withdraw funds, or add to the balance rate. Okay. So now I'm going to go to trustee. I kind of like this. The I like that he ladders the CDs that way, 3 months. It's both not that frequent, but still frequent enough to where, like, let's say you lost your job, you got fired. It will come in to sustain yourself within time, right? Because you use the 1 month. The 1 month emergency fund, then the 3 months in the MMF, and then you get the CDs every 3 months. Yeah. Okay. So I think I got the gist of it. I think in my opinion, it's an alternative to HISAs. That is very sensible in a lot of situations. I, however, am in a state that enforces, this is Arial 10, that enforces state taxes. It's not 10. In which case, I think I benefit more from treasury bills, because treasury bills do not get, they are tax exempt at the state level. So I think I will do that. I think I'm gonna chill with, I like the treasury bills approach still more. So I think that's where I'm at right now. Yeah. Treasury bills, they're just so, they're so juicy. So I want to read this book, I Will Teach You How to Be Rich. Trying to figure out how I'm going to do this. I'm going to need to get a camera so that you can see me reading it and taking notes of it. But I'm trying to figure out how to do this. Okay. Let me figure this out. Okay, I think I gotta do this off stream. Cause yeah. Cause I don't want to just read it. I want to like, so that you guys can see my notes. Yeah. Right? That was a crazy. It's a huge book, bro. 300 pages. Yeah, I'm gonna need the camera, so then I have to figure out how to set that up. I have no clue, so I will do that. So this is the end of the stream.